We are currently witnessing a statistical anomaly in the order books that very few retail investors are paying attention to right now. While the mainstream media is busy distracting you with headlines about price volatility or political rumors, the institutional data is telling a much darker and more urgent story. For the first time in months, we are seeing a sustained divergence between Bitcoin price action and the net capital flows from the world's largest asset managers. If you are currently holding a significant position in Bitcoin, or if you are planning to buy this dip thinking it is just another standard correction, you are exposing yourself to a level of risk that you likely do not understand. The reality is that the smart money is not just sitting on their hands. They are actively repositioning, and the on-chain signals suggest a massive rotation of capital is underway. In the next 8 minutes, I am going to walk you through the exact institutional data points that explain why giants like BlackRock appear to be stepping back from the table. We are going to look at the liquidity metrics, the macroeconomic pressures, and the internal rebalancing mandates that are forcing these big hands to sell. Do not make another move in this market until you understand the mechanics behind this institutional exit. Let us get into the weeds. To understand why an entity as powerful as BlackRock would reduce exposure or appear to be fleeing from Bitcoin, you have to stop thinking like a crypto enthusiast and start thinking like a risk manager. These institutions do not trade based on emotion, and they certainly do not trade based on the ideology of decentralized finance. They trade based on mathematical models, liquidity constraints, and risk-adjusted returns. The first piece of evidence we need to examine is the flow data coming out of the spot exchange-traded funds. For months, we saw a relentless bid, a constant stream of buying pressure that absorbed almost all the selling from miners and long-term holders. However, over the last 30 days, that trend has not just slowed down, it has fundamentally reversed. We are seeing consecutive days of net outflows, meaning more money is leaving these products than is entering them. This is not a coincidence, and it is not a retail panic. Retail investors do not move the market in hundreds of millions of dollars in a single session. This is institutional rebalancing. Here is why this matters. When you see a firm like BlackRock showing negative flows, it is often tied to the broader macroeconomic environment, specifically the behavior of the Federal Reserve and the bond market. Right now, we are sitting in an environment where interest rates remain stubbornly high. The yield on the 10-year United States Treasury bond is offering a risk-free return that is becoming increasingly attractive to large-scale capital allocators. You have to understand that for a portfolio manager, Bitcoin is classified as a high-risk, high-beta asset. When the risk-free rate, the money they can make by literally doing nothing but holding government debt, goes up, the mathematical justification for holding volatile assets like Bitcoin goes down. They are not fleeing because they believe Bitcoin is failing. They are fleeing because the cost of capital has become too expensive to justify the risk. This is a mechanical unwinding, not an emotional. Furthermore, we need to talk about the concept of the carry trade and how it impacts the price action you are seeing on your screen. For a long time, hedge funds and institutions were playing a game where they would buy the spot Bitcoin and short the futures contract to capture the spread. This arbitrage strategy created massive buying pressure on the spot market, inflating the inflows we saw earlier in the year. However, as the spread between spot prices and futures prices compresses, that trade is no longer profitable. When that trade unwinds, they have to sell the spot Bitcoin they bought. The reality is that much of the adoption we celebrated was actually just arbitrage traders exploiting a gap in the market. Now that the gap is closing, the capital is leaving. If this analysis is helping you see through the fog of war and understand the real mechanics driving prices, consider subscribing to ensure you never miss a critical update. Now, I want to take this a step deeper and look at the over-the-counter trading desks. These are the private marketplaces where institutions trade to avoid moving the public price. Typically, when institutions are accumulating, we see massive withdrawals from exchanges into cold storage, and over-the-counter balances deplete. Right now, we are seeing the opposite. Exchange reserves are beginning to tick up, and over-the-counter desks are reporting a surplus of inventory. This tells us that the big hands are distributing coins back into the market. They are selling into the liquidity provided by retail investors who are buying the dip. It is a classic distribution pattern that we have seen at the top of every major market cycle in history. Another factor driving this potential exodus is the looming threat of a recession or a hard landing for the economy. BlackRock and their peers have access to economic data that is far more granular and timely than what the public sees. If their internal models are flashing red for a recession, their mandate requires them to move into defensive assets. In a liquidity crunch, institutions sell what they can, not necessarily what they want to. Bitcoin, being one of the most liquid assets in their portfolio that trades 24 hours a day, often acts as the first source of cash when they need to raise liquidity. They treat Bitcoin like an endless ATM machine during times of stress. So when you see them selling, it might be a signal that they are preparing for a broader market crash across stocks and real estate. They are raising cash now to buy distressed assets later. This is the difference between playing checkers and playing chess. While retail investors are looking at charts and drawing triangles, institutions are looking at liquidity cycles and credit spreads. We also need to discuss the quarterly rebalancing effect. These large funds have strict rules about how much of their portfolio can be allocated to any single asset class. If Bitcoin had a massive run-up in the first 2 quarters of the year, it might have exceeded their allocation limits. To stay compliant with their own risk rules, they are forced to sell the winners to bring the portfolio back into balance. This is why we often see selling pressure, even when the fundamental news seems positive. It is purely mechanical selling. However, the retail market interprets this as a loss of confidence, leading to panic selling, which further drives down the price. The institutions know this, and they often use this panic to their advantage. But right now, the data suggests they are net sellers. If you want to stay ahead of these institutional games and receive these insights before the rest of the market catches on, make sure you are part of our community by hitting that notification bell. Let us pivot to the regulatory landscape, which is another silent killer of institutional momentum. While the approval of the exchange-traded funds was a green light, there is still massive uncertainty regarding custody rules and the accounting treatment of digital assets for banks. Institutions hate uncertainty more than they hate bad news. With the current political climate in the United States shifting and the regulatory bodies tightening their grip on the crypto ecosystem, compliance departments at these major firms are likely calling for a reduction in exposure. They are de-risking ahead of potential regulatory enforcement actions or legislative changes that could complicate their holdings. It is safer for them to step to the sidelines and wait for clarity than to hold the bag during a regulatory crackdown. You must also consider the liquidity depth of the market. As prices drop, the order book thins out. For an entity moving billions of dollars, slippage becomes a major concern. If they believe the trend is turning bearish, they need to exit before the door closes. If they wait too long, their own selling will crash the price so hard that they cannot get out at a decent average. Therefore, they sell early, and they sell aggressively. This is what we call front-running the exit. They are getting out before the mass panic sets in. The on-chain metric known as coin days destroyed has also seen a spike recently. This metric tracks the movement of coins that have been dormant for a long time. When we see a spike in this metric, it means that long-term holders and whales are moving old coins. Historically, this is a strong signal of distribution. It means the conviction of the old guard is wavering, or they are taking profits off the table to rotate into other sectors. So when you combine the negative flows from the exchange-traded funds, the unwinding of the carry trade, the rise in exchange reserves, and the spike in coin days destroyed, the picture becomes very clear. The big hands are not necessarily abandoning Bitcoin forever, but they are certainly exiting their positions for the medium term. They are shifting into cash, bonds, or defensive equities to weather the coming storm. The narrative that institutions will only buy and never sell is a myth sold to retail investors to provide exit liquidity for the whales. The reality is that they are traders first and believers second. So, what is the playbook for you in this environment? First, do not try to catch a falling knife. If BlackRock is selling, you do not want to be the one bags at these levels. You need to wait for the data to shift. Watch the net flows of the exchange-traded funds closely. We need to see a return to sustained inflows for at least a week to confirm that the institutional bleeding has stopped. Second, keep an eye on the 10-year Treasury yield. If rates start to drop significantly, that will be the signal that the risk-on environment is returning. Until then, cash is a position. Preserving your capital is more important than chasing a bounce that might be a dead cat. The market will always be there, but your capital will not be if you trade against the institutional tide. Do not let the fear of missing out drive your decisions when the data is screaming caution. Understand that this is a game of patience and information asymmetry. Right now, the information suggests caution. The big hands are showing you their cards, and those cards say, fold. Listen to what they do, not what the headlines say. In conclusion, the perceived flight of capital from Bitcoin by major players is a rational, calculated response to macroeconomic conditions and market mechanics. It is a rotation, a rebalancing, and a risk management strategy all rolled into one. Stay liquid, stay observant, and wait for the smart money to signal the next entry. Disclaimer: I am not a financial advisor. Everything shared in this video is for educational and informational purposes only. Digital assets are highly volatile and carry a high degree of risk. You should conduct your own due diligence and consult with a certified financial professional before making any investment decisions. The market can remain irrational longer than you can remain solvent. Trade safe,